Hi there, welcome to my channel where you can follow my journey to set up and maintain a dividend portfolio for my 4-year-old daughter. This is episode 8 of the journey, June 2020. I bought the 6th dividend paying stock and give an overview of the portfolio and the market in May. This time the video is a bit longer. I'll take some time to discuss why I bought the stock I bought for June, my recent stock. If you like to follow my journey and see the dividend portfolio of my daughter grow, then please subscribe to my channel and hit the bell to get notified when I upload a new video. Let's do a small recap from my previous videos. I have bought 5 dividend paying stocks. Okay, one cut its dividends. I bought AbbVie, Disney, 3M, Waste Management, and my last stock was AT&T. In the last video, May 2020, I mentioned that my first way to diversify is by buying a stock in each sector that eToro offers. The idea behind this diversification is to reduce the risk of the entire portfolio. While one sector can suffer badly from an event, other sectors may thrive, even in a situation where we are in now. Mostly it is important that you do not put all your eggs in one basket. You may be lucky, and it is a very profitable basket. But when you are investing for the long term, as I am, you do not want to gamble since your portfolio can be hit very hard if the one sector you are betting on gets a downfall. So with 5 stocks already, I bought into 5 sectors. Healthcare, I bought AbbVie, Disney for services, 3M conglomerates, waste management, industrial goods, AT&T in technology, and for this month I decided to pick a stock which is in the sector consumer goods. But first, let's look at where the portfolio is standing right now. What happened in the stock market in May, and of course, then I go to what stock I bought for June and why. Well, what happened in the market in May? After a green April, May was very green as well, especially the last 2 weeks. The S&P 500 went up from 2900 up to 3050. As you may remember, I went from 20% in the red up to 6% in the red, which was great, but still it was in the red. At the end of May, my total portfolio is in the green, about 3%. Next to the S&P 500, all my dividend stocks are well up and only Disney is still quite red. All other stocks are in the green and are up about 10% or more. Even though Disney is 14% in the red, it made quite a jump from 23% in the red. And remember that I bought Disney close to its all-time high, just before the stock market crashed as my February stock. 3M is now almost 3% in a plus, AT&T 4%, AbbVie 5%, and Waste Management almost 21% in the green. And that's nice compared to the previous months, especially March. And with my latest stock, AT&T, I bought a great stock with a high dividend yield of 7%, a great addition to the steadily growing dividend portfolio. On my eToro account, which you can view using the link below this video, you can see the current status of my portfolio. So my paper losses are gone. Overall, I'm in profit, for what it's worth. Looking at the current situation in the stock market, it seems like the bear market never happened. I'm very curious what happens in the following months. Lots of countries are easing the restrictions. People can get a haircut again, and people can get to restaurants and so on. But still the unemployment rate is huge. So much money is printed, and companies have been hit hard. And what did I buy this time? Because of diversification, I picked a sector and looked at the stocks in that sector. In one of the comments of a previous video of mine, someone suggested Coca-Cola. And yes, I believe that is a good stock, but I do not want to buy stocks blindly, and had to look a bit further and compare some companies in a certain sector. Since Coca-Cola is in the sector consumer goods, I choose this sector to search for stocks. 3 options popped into my mind: Coca-Cola, Pepsi Cola and Dr. Pepper. And there's a bit of personal history there. It has been a while since I have been to the United States, but I went to it a couple of times from about 1 month up to 6 months each time. I really enjoyed traveling around and have seen most of the states. The southwestern part with the Grand Canyon, Death Valley and all these national or state parks fascinated me the most. Well, let's not get into that too much for this video, but during those driving days, and there were many, we usually end up at a fast food restaurant for dinner. I always used to like a cola and like both Pepsi and Coca-Cola, although I slightly prefer Pepsi. But I could not get both at a restaurant. When asked, I usually get the reply, we only have Coca-Cola or we only have Pepsi. And usually Coca-Cola was served. Fewer fast food restaurants had a contract with Pepsi, I guess. And then there's Dr. Pepper, which I did not like, but a friend of mine preferred this over any cola. So with this in mind, I thought, why not examine Coca-Cola, Pepsi Cola and Dr. Pepper, or Keurig Dr. Pepper. All companies with dividend-paying stocks. I followed the steps of the video of Gen X dividend investor to analyze a dividend stock. He shows 7 steps to quickly analyze a dividend stocks in the video How to Analyze a Dividend Stocks in 60 Seconds. It took me a bit longer though, but hey, it's the first time I'm doing it this way. I will put down all the links where I found the information during these 7 steps beneath this video. The first step is to look at the dividend yield. Dividend yield is the annual dividend paid divided by the stock price, and this times 100 to get the percentage. A yield between 3 and 7% is considered to be a good catch. The dividend yield of Coca-Cola is 3.48. Pepsi has 3.09 and Dr. Pepper 2.16 at the time making of the video. Both Coca-Cola and Pepsi are in the range between 3 and 7%, so there may be a good catch. The second step is to check the dividend growth of 10 years or more, a sign that the dividend is solid and makes it attractive for investors. Coca-Cola increased its dividend for 57 consecutive years, and this makes Coca-Cola a dividend aristocrat, and even a dividend king. The dividend aristocrats are S&P 500 index constituents that have increased their dividend payouts for 25 consecutive years or more. Dividend kings increase their dividend payouts for even 50 consecutive years or more. There are not that many dividend kings. Pepsi didn't do so bad either. Pepsi increased its dividend for 47 years in a row. It makes it a dividend aristocrat as well, which is great. Keurig Dr. Pepper, I had to look closer to what happened to the stock price. It's a company that came from the merge of Keurig Green Mountain and Dr. Pepper Snapple Group in 2018. It did not increase its dividends last year, so it's not part of a dividend aristocrat or any. The merge made it actually a bit harder to evaluate at how it all performed in the past. Well, at least for me it did. In this case, Coca-Cola and Pepsi meet the criteria with ease, and Dr. Pepper does not. The third step is to look if the payout ratio is under 70%. The payout ratio is the amount of earnings paid out in dividends. The dividend payout ratio is net income divided by the dividends paid, which is ideally 70% or less. We do not want a company that pays almost every cent they earn into dividends only. If the company gets into some kind of headwind, then the first and only thing they can do is to reduce or cut the dividends to get ahead. As an investor, you want the dividends to grow, not to get cut or reduced, although the 70% limit is not a guarantee. All 3 stocks are around 70%. Coca-Cola is just beneath the 70%, with 68.4%. Dr. Pepper with 71.5% is just above, and Pepsi a bit higher with 73.7%. The fourth step is to look at the 5 years dividend CAGR. The dividend CAGR, or compound annual growth rate, is a fast way to measure the dividend growth. Numbers you would like to see is 7%, and if that is not met, then just add the previous mentioned dividend yield. If they add up to 9%, then it's still okay. Coca-Cola has 5.6%, Pepsi a nice 8.6%, and Dr. Pepper a minus 18.8%. When you add the dividend yield, Coca-Cola gets a 9.1%, Pepsi an 11.7%, and Dr. Pepper a minus 16.6%. Pepsi meets both criteria easily. Coca-Cola just hits the 9% if the dividend yield is added. Dr. Pepper is a different story and cannot be compared using the 5 years CAGR. Because of the merge, they paid a huge dividend of over $100 per share in 2018. This caused the share price to drop with approximately the same amount. Since there's a huge difference between that one dividend payout and the following, the 5-year dividend CAGR for Dr. Pepper is not realistic and cannot be used. The fifth step is to check the trend of the dividend yield, a way to check the ratio of the stock price and the dividend payout over the years. If the stock price rises faster than the dividend payout, you get a downtrend. You would like to see an uptrend where the dividend payout rises more than the stock price. I'll just check the last 5 years. For Pepsi, you see an almost straight line. And it goes the same for Coca-Cola. For Dr. Pepper, again, you can only look at data from 2018. If you consider this, you can see it first rising and then go steady in 2019. So all three are not good, but also not bad. The sixth step is to look for the year-over-year trends of the revenue of a company. I would like to see a rising trend. If you look at Coca-Cola, you do not see an increase, even in decline for the first quarter of this year. Pepsi, however, shows an almost ideal increase in revenue, so that is great to see. Dr. Pepper again, with the merge, I looked from 2018 only. There is still an increase, but it is slowing down. So Pepsi definitely shows the best numbers here. The last step, number 7, is looking for increasing year-over-year cash flows. Coca-Cola shows a nice increase from 5.4 billion in 2017 up to 8.4 in 2019. Pepsi, however, does the opposite, and there is a decrease in free cash flow from 7 in 2017 down to 5.4 in 2019. Dr. Pepper shows a great increase from 0.8 in 2017 up to 2.1 in 2019. So Coca-Cola and Dr. Pepper show the best numbers here. Now to look at an overview of the steps and the results. Coca-Cola and Pepsi meet the criteria for dividend yield, step 1. And dividend growth as well for more than 10 years, step 2. Coca-Cola just meets the criteria for the dividend payout ratio in step 3. Pepsi and Dr. Pepper are just over that criteria. Pepsi meets the criteria of step number 4 for the 5-year dividend CAGR easily. And Coca-Cola meets the criteria if the dividend yield is added. This step cannot be used for Dr. Pepper. In step number 5, the trend of the dividend yield, we mostly see a straight line, so no good or no bad for all stocks. Pepsi is the only one that meets the criteria of number 6, a year-over-year rising trend of the revenue. For step number 4, an increasing year-over-year cash flow, Pepsi is the only one that does not meet that criteria. If we look at the outcome and assume that each step has the same value, Pepsi and Coca-Cola go head to head. So to look a bit further, I have added another step, step 8, to see what the company embodies. PepsiCo is not just Pepsi, the drink. It also includes other brands, like for example Lay's, Doritos, Gatorade, and Mountain Dew. For Coca-Cola, it is the same. It embodies other brands as well, like Fanta, Monster, Sprite, and Minute Maid. Pepsi shows a bit more diversification in its products, and therefore seems a bit more future-proof. And since what I mentioned before, I like the taste of Pepsi slightly more, So I've added another step, step 9. Of course, this is a bit personal. So to take all the results in consideration, I have chosen to buy PepsiCo. In my opinion, this is the best option to buy from these 3 options. Not to say that Coca-Cola or Dr. Pepper is not a good investment. So on the 1st of June, I bought for $50.47. I received a dividend payout from AbbVie, 0.38 unit of the PepsiCo stock, my 6th stock, and this one in the sector consumer goods. If you want to check the current status of my dollars portfolio, you can look at the link below the video to eToro. Feel free to follow or copy the portfolio if you have an eToro account. I hope you like this video. It's a bit longer and a bit more in detail. If you do, please like and subscribe and hit the bell button. This really helps to grow my channel. I hope to inspire more people to look for long-term investments, especially for their kids like I do. There are a couple of links below the video if you're interested in the numbers I use. I only put the links down to the stock I choose, PepsiCo. The links to the other stocks are quite similar and can be found by just replacing Pepsi or PEP, the ticker symbol, into the name of the ticker of the other stock. And of course, a link to the portfolio of the eToro account where you can see the current status. Remember though that I am not a financial advisor and this is for entertainment purposes only. Any investment has risks. Do your own research. Thanks for watching and see you next video.